Topic examines the major sources of liquidity risk within financial institutions and explains how liquidity transformation creates both profitability opportunities and systemic vulnerabilities. Liquidity transformation occurs when institutions fund long-term, illiquid assets using short-term liabilities that can be withdrawn or refinanced frequently. Banks, broker-dealers, and shadow banking entities depend heavily on this maturity mismatch to generate earnings. However, the strategy exposes institutions to sudden funding pressures if creditors lose confidence or market conditions deteriorate. Liquidity risk may arise from funding withdrawals, margin calls, collateral demands, or disruptions in wholesale funding markets. The topic emphasizes that liquidity transformation is fundamental to modern finance but requires strong risk management to remain sustainable. A central source of liquidity risk is the dependence on short-term funding mechanisms such as repurchase agreements, commercial paper, and interbank borrowing. These markets function efficiently during stable conditions but can freeze rapidly during periods of stress. Institutions relying excessively on wholesale funding are particularly vulnerable because lenders may refuse to renew financing or demand significantly higher collateral. The topic discusses how confidence shocks can spread quickly through interconnected financial markets, triggering widespread liquidity shortages. Financial firms therefore maintain liquidity reserves, diversify funding sources, and monitor refinancing exposures carefully. Effective liquidity management requires balancing profitability objectives with the institution's ability to withstand stressed market conditions and unexpected funding disruptions. The topic also highlights systematic funding risk, which refers to liquidity pressures affecting the entire financial system simultaneously rather than a single institution. Systematic funding crises emerge when many institutions depend on similar funding structures and react identically under stress. During financial crises, lenders often reduce exposures broadly, causing funding markets to contract sharply. This creates systemic instability because institutions attempt to deleverage simultaneously by selling assets or reducing lending activities. The resulting contraction in liquidity amplifies economic downturns and market volatility. Regulators therefore monitor system-wide funding dependencies and interconnected exposures closely. Understanding systematic funding risk is essential because individual institutions may appear stable independently while collectively contributing to broader financial fragility. Topic also focuses on collateral markets and leverage, which play crucial roles in modern liquidity management and financial intermediation. Collateralized borrowing arrangements allow institutions to obtain financing at lower costs because lenders receive assets as security against default risk. Common forms of collateral include government securities, corporate bonds, equities, and structured financial products. The quality and liquidity of collateral significantly influence funding availability and borrowing costs. During stable market conditions, collateral markets support leverage expansion and efficient capital allocation. However, when collateral values decline or market participants lose confidence, lenders may demand larger haircuts or additional margin, creating severe liquidity pressures. The topic emphasizes the interconnectedness between collateral quality, leverage, and financial stability. Leverage magnifies both profitability and vulnerability within financial institutions. By borrowing funds against collateral, institutions can increase asset holdings and enhance returns on equity. However, excessive leverage creates sensitivity to declining asset values and funding disruptions. The topic explains how leverage cycles contribute to financial instability because rising asset prices encourage additional borrowing, while falling prices trigger forced deleveraging. Margin calls and increased collateral requirements during stress periods can force institutions to liquidate assets rapidly, depressing prices further. This process creates a destabilizing feedback loop between leverage and market liquidity. Risk managers therefore monitor leverage ratios, collateral quality, and stress scenarios carefully to maintain institutional resilience. The topic further explores the mechanics of collateral rehypothecation and securities financing transactions. Rehypothecation occurs when institutions reuse pledged collateral to support additional borrowing or trading activities. While this practice improves market liquidity and funding efficiency, it also increases interconnectedness and systemic risk. The failure of a major institution can disrupt collateral chains and reduce confidence across financial markets. Securities financing transactions such as repos and securities lending are therefore essential components of modern liquidity creation, but can also become channels of contagion during crises. Regulators increasingly focus on transparency, collateral management standards, and leverage constraints to reduce systemic vulnerabilities associated with collateralized funding markets. Topic also examines the relationship between funding, transactions liquidity risk, and transaction costs in financial markets. Transaction costs include bid-ask spreads, brokerage fees, market impact costs, and execution delays that arise when trading assets. During normal market conditions, these costs remain relatively stable and manageable. However, stressed market environments can significantly increase transaction costs as liquidity deteriorates and trading activity becomes more difficult. Institutions attempting to sell large positions may face substantial price concessions because buyers withdraw from the market. The topic highlights that liquidity-adjusted transaction costs must be incorporated into valuation models, risk management frameworks, and portfolio strategies to avoid underestimating potential losses. The final section emphasizes the integrated nature of funding liquidity, market liquidity, leverage, and transaction costs within the broader financial system. Liquidity stress often originates from the interaction of these factors rather than from isolated events. Funding pressures may force asset sales, increasing transaction costs and reducing collateral values, which then intensify leverage constraints and liquidity shortages. This interconnected process can rapidly escalate into systemic crises if institutions are insufficiently prepared. Effective liquidity risk management therefore requires comprehensive stress testing, diversified funding structures, robust collateral management, and prudent leverage policies. The topic concludes that maintaining market confidence and financial resilience depends on understanding how liquidity dynamics evolve across institutions, markets, and economic cycles simultaneously.